Welcome back, everyone. Next, we have Fieldpoint Equity. It's a private company whose leadership delivers experienced stewardship of capital with cutting-edge company operations. The team leverages over 30 years of combined experience managing people, operations, and outcomes, with a deep bench of supporting talent spanning fund management, full-cycle business operations, construction, and marketing. Happy to welcome General Partner Owen Carhart. We'll also welcome Parker Evans and Daniel Campana later for the Q&A. Welcome, Owen. How are you today?
I'm wonderful. How are you doing today?
Great. We're very excited to hear your presentation. So the floor is yours. Call me back when you're ready for some questions.
Absolutely will do. Thank you so very much, Anna, and good morning, everyone. It's really a pleasure to be here presenting to everyone regarding Fieldpoint Equity. We are a boutique private equity firm located in Nashville, Tennessee, and excitingly, we're opening another office in Miami Beach, Florida next month, which is where I'm currently located. Normally it's sunny here, but today a little bit cloudy. Our goal is to provide stewardship and place precision and strategic investments in American infrastructure, specifically American infrastructure in the South and Southeast, with the outcome aim being to provide exceptional returns. Companies we invest in provide predictable and recession-resistant cash flows, which are also tax efficient. We invest in companies that are poised to benefit from a $1.2 trillion infrastructure bill that was passed in 2021, with $500 billion of that investment money being spent over the next 5 years. And our leadership team brings diverse expertise in asset management and business optimization. And I'm going to digress on each of these 3 points throughout the presentation this morning. And so bear with me as we do that. Thank you. Our leadership team consists of myself, Parker Evans, and Daniel Campana. All 3 of us are managing partners. Parker Evans is a general partner, a general securities representative, and an investment advisor. He holds Series 7 and Series 66 licenses, and he's managed portfolios in excess of $1 billion with an average portfolio size of $20 million. He specializes in implementing tax-efficient strategies while optimizing performance of the companies. Daniel Campana, from 2014 and onward, served as a chief portfolio officer at a private equity fund with over $500 million in assets under management. And he was responsible for the entire spectrum of company engagement of 52 portfolio companies, specializes in company management, valuation, reporting, effective communications, and specializes, particularly of interest for all of you, in distributions to limited partners. And myself, I am an entrepreneur and businessman residing in Miami, Florida. I have broad business development expertise in a number of different areas. I also have a background in financial advising and investment advising, similar to Parker. And I'm also a civically engaged citizen that works to ensure that we're working very closely with the companies which we're acquiring and providing growth capital to, as well as doing good for the communities in which they're serving. So I want to chat a little bit about why that team is so important. Solid management and focused expertise combined with a unique investment thesis propagates investment opportunities with the potential for outsized returns. Our targets are infrastructure and construction companies in the South and Southeastern United States, as well as South Central United States. And we're looking specifically at construction companies, paving companies, heavy equipment rental companies, horizontal drilling companies, which we'll dig into a little bit later. And our target companies are smaller than what a typical private equity fund would acquire. We're looking at 1 to 5 million in EBITDA. And this allows us the opportunity to work very, very, very closely with the owners of these companies. I'm sure that everyone here has heard that we're undergoing currently the largest wealth transfer in American history. The types of companies that we're purchasing and providing growth capital for are well-established companies, small and medium-sized, that are looking to exit now or exit in the near future, and thus are looking for capital either to be acquired or capital to grow to increase the valuation over time. And that's where our fund comes into the picture. We do this extremely efficiently. We remove sponsors and brokers from the transaction, which results in incredibly efficient acquisitions and placement of growth capital. This means less costs to you, the limited partners, and more direct access to the CEOs and management of these companies. We assist these companies after we acquire or purchase or, provide growth capital to them in developing their leadership and professionalizing their companies. Many of these assets have been running their companies for 30 years or 40 years or more, and are simply looking for professionalization so that we can target and add on additional companies that are synergistic with them, so that they become more efficient in their operations and they're able to scale. And because we're targeting these smaller, quote unquote, smaller companies and medium-sized companies, our entrance multiples are significantly more attractive. And we're able to find companies within the regions that we're working in that are synergistic so that we can add them on, merge them, and create them into larger operations. I want to talk a little bit about the Infrastructure Investment and Jobs Act that was passed in 2021. That act and that legislation provides an incredible opportunity for the infrastructure business to thrive over the next decade. Over $1.2 trillion in authorized spending was authorized in the bill, $550 billion of it being allocated over the next 5 years. $200 billion of it has already been authorized and allocated within the first year and was reauthorized from a previous act during the pandemic. And it covers all modes of transportation, including roads, bridges, and major projects, passenger and freight rail, resiliency, public transit, electric vehicles and buses, safety and research, ports and waterways, airports, water infrastructure, broadband, and power and grid. Now, a lot of times people think that when the government's coming in to invest, it's going to crowd out private investment. But because the act is spreading the funding over the next 10 years, with the majority of the investment being over the next 5, it's actually a feature of the act rather than an impediment. And so it allows for private equity firms like ours to come in, assist smaller firms in acquiring the capital from the act through the professionalization and optimization process, and is really a feature of the act, so that we're able to work with them on acquiring this funding, which ensures significant cash flow over the next 5 years. On all of those categories I just mentioned, about $17 billion is going to ports and waterways, $65 billion to broadband, roads, bridges, and major projects, $111 billion, and power and grid and utilities, $79 billion. And I'm going to expound a little bit about that on the next slide, because we have specific areas that we wish to work for specific reasons. So our fund strategy is really to work mainly with roads, bridges, and major projects, power and grid and utilities, broadband, and resiliency. And as I mentioned earlier, I'm here in Miami Beach. We have a resiliency issue here. The government here, the Miami Beach Commission, actually put pumps up in Miami Beach, and it created a whole problem because the issue became, where do you put the pumps? The pumps are big and loud. Then they found a way to put the pumps under the ground. And so to get them under the ground, you have to dig. In order to dig, you need heavy equipment. In order to get the wiring and the piping to the pumps, you need to drill. And so I'm using that as an example because that one simple act, that one simple requirement requires multiple companies to do it. In this case, we're very, very interested in working in the major projects and companies that are servicing those major projects, because we need the horizontal driller to get the pipes, to get the wires, et cetera, over to the pump. Broadband is another area which we're very, very interested in. And we have a case study that we'll discuss at the end. But we have a horizontal driller, which we've recently funded. They originally were in oil and gas. So they changed their business model over to working with utilities and broadband, because you can utilize the same technology of drilling down and then horizontally to place wires and broadband infrastructure that you were using in commodities. And you remove the cyclical nature of the commodities industry and focus on infrastructure rather than focusing on commodities. And this allows us to produce significantly better returns. We're expecting to produce 23% rate of return year over year. And we're expecting that we actually might outperform that this year, but to be reasonable, we're going to stick with a 23% expectation. And that's for a number of reasons, which we've already mentioned. We're much closer to the operations of the company. We're much closer to the acquisitions of the company. And we also sit on the same side when it comes time for those companies to exit as the seller, rather than working, as the buyer. We identify opportunities in a number of different ways. We're looking to, we're looking at companies that are very small and very local, and we have an extensive network of individuals that we know in the industry who are able to help us identify and call on companies that are looking to potentially sell. We like to discuss the risk landscape a little bit. It's important that we're all aware of what we're placing our funds into. The largest risk right now in the industry that we're talking about is a potential labor shortage. There was a job opening rate in 2022 of 5.5, which means there were 5.5 jobs open for every 100 positions, which is pretty high. In 2023, April of 2023, that number dropped to 4.6. So the trend is moving in the correct direction. The reason for that in many of these areas is because inflation has increased, but wage improvement has not increased. And another potential risk is that as wage increases, it's going to put pressure on the cash flows of the company. We mitigate that by utilizing a regional strategy. The regional strategy of the South, the Southeast, and South Central of the United States are growth areas. They're gaining in population, which means additional labor is in the market. So that 5.5 in 2022 and 4.6 in 2023 is decreasing. And we're getting near, we're waiting for new statistics, but we're getting near the pre-pandemic metric of 3.0, specifically in those areas. And the reason is because people are moving to those areas because of job opportunity, because there's a ton of growth, and because they're tax-efficient areas to live in. Another way that we mitigate these risks is with our bolt-on acquisitions. So if we have a company that is paving a road, or we have a company that is building a building, we are also looking at merging those companies with companies that rent the equipment so that they can get better rates. So we're constantly targeting synergistic companies that we can flow together. Finally, we ensure that all of our companies maintain significantly strong cash reserves, and we provide some of those cash reserves. And with the new legislation, we should expect those cash reserves to grow and cash flow to be stronger moving forward. Let's just talk a little bit. I'm not going to go too much into the projections, but we're looking at $50 million of assets under management. As I mentioned, we're a boutique private equity fund. Our average transaction size is around $6 million. And so if you remember, I had mentioned we have attractive multiples. We're looking at 2 to 3x of revenue. Our EBITDAs are 1 to 5 million. And we're looking to do around 8 to 9 deals, depending on the different types of companies, with a limited preferred return of 8% over each year. What are we offering? Our offering size is $100 million. Our minimum commitment is $250,000. Our target return, as I mentioned before, is 23%. We're holding these companies for between 5 and 7 years. We're doing a traditional 80-20 split with a catch-up of 2%, 8 to 12 investments. 8% is our regular return, and 9% is the preferred return of an investment over $1 million. We do also look forward to working with people who are interested in co-investing and founding investing. So I chatted a little bit earlier about the horizontal drilling company. I'm not going to read the entire slide to you, but essentially that company had $2 million in EBITDA. Current EBITDA is $25 million. We've learned a lot of lessons from our previous experience. And the biggest, which I've mentioned we're implementing right now, is maintaining extremely close relationships with the asset, which is why we're removing sponsors and brokers from our acquisition. We have people on the ground, on the board, everywhere reporting back to us so that we understand the operations of the company. We have direct access to the acquisition and the operator, and this saves on costs to the fund and saves on communication issues. Secondly, we really are looking at the power of changing the perspective and the focus from working in oil and gas, working in commodities with horizontal drilling, to working in infrastructure. That's the major takeaway. If you're able to change the area that you're working, you're able to more predictably generate cash and therefore generate return. Our other potential fund acquisition is an equipment rental company. The size of that acquisition was $3 million EBITDA. We're looking to exit at $30 million EBITDA. This one particularly outlines the power of executing an M&A strategy. Rather than growing organically by finding new customers, finding new contracts, we were able to execute a strategy with this company where we're acquiring companies through a broad area of synergistic companies so that they can continue to help the company grow with their customers and maximize the efficiency of those companies. By having broader collaboration, we're able to have more outsized returns and new acquisitions. And with that, I'd like to bring Anna back. And she has, I think, a few questions from the audience. And my general partners, Parker and Daniel, are going to join us.
Perfect. Thank you, Owen. Great presentation. All right, we got everyone on. Hi, gentlemen. All right, let's start with a general question about what differentiates you from other funds in this space. How do you stand out?
I can take that. Thank you, guys. Thank you for the time. As Owen has explained throughout the presentation, what makes us different than other private equity funds is that we have a direct access and we're working alongside the operators as opposed to having a owners and operator relationship. So we essentially work hand in hand with the operators to make sure that the company meets its business plan. So instead of just taking a passive approach to these type of investments, portfolio companies, we roll up our sleeves and work with the operators to make sure that we're hitting the returns for everyone, for the LPs.
Thank you for that.
Yeah, I would add to that our size makes us unique as well. We're not a gigantic firm, and that helps us to be able to work more closely with the companies which we're providing growth capital for or acquiring. And that's a huge advantage for us specifically.
Well, a few questions from our viewers. Ron Goodwin wants to know, is infrastructure your target industry, or do you diversify into other industries? Infrastructure
is the target industry. we might look at something as long as it's infrastructure related. If they had a revenue stream that was outside of infrastructure, I don't think we would necessarily count them out. But infrastructure is 100% the target industry for the reasons which I'd mentioned earlier, which particularly is their ability to be poised to take advantage of a significant amount of money coming into that industry from the federal government, which allows it to be predictable with cash and cash flow coming into the companies, which helps us create predictable and better returns, and also provides some resistance to economic downturn. If anything, should we have an economic downturn, we should expect more money to go into infrastructure because the government will continue to invest more in order to prop up the economy.
And something to add to that, that's great. And I everything Owen said, completely agree with. To add to that, at the end of the day, and very nice to meet you guys, appreciate the opportunity. With the owners of these businesses that we acquire, to Owen's point of the multiple that we come in at, where you purchase these companies and come in to the valuation multiple of these companies when you enter is everything, right? What you buy at, what you purchase the asset at is everything. With these owners that we get to work with in the infrastructure space, a lot of them are the mom and pop owners that are older in age, that are looking for that right opportunity and next individuals to come in those companies and take them over. Working with these companies in the infrastructure space, there's more opportunity that we can drive the right price working directly with the owners in this space.
And James asks, when you acquire a company, they're obviously private. So what's your exit strategy? Is it a public listing or further M&A by a larger company?
So we are in a new decision because we are acquiring companies before they are attractive to larger private equity funds. So we acquire a company at a $1 to $5 million EBITDA, and we grow the company to 20 to 35 when they become really attractive to larger private equity funds that are not as nimble, that are not as willing to work directly with the operators. So we have two different exit scenarios. We can either sell it to a larger private equity fund, think Blackstone, think HIG. They want to participate in the industry, but they don't have the experience to be able or the willingness to work with this type of companies at the moment. The second exit scenario is, yes, going public. There is a scenario where some of these companies will grow large enough to be able to take public. So what's attractive of working with the smaller companies is that the exit scenarios, we have multiple of them instead of just taking it public, which can take a long time and it's very costly.
So Chris Sharp asks, do you have a fund, and how can an investor get involved in your deals?
Yes, we have a fund. That's absolutely why we're here, is to communicate with potential investors and to generate conversations. We hope that we generate a lot of interest, and you can simply go to fpefunds.com and enter your information, and somebody will reach out, or I believe you should have our information, and you absolutely feel free to reach out at any time, and we'll be happy to have a longer, more detailed conversation about our strategy.
And Luke Harper wants to know if you are hiring within your firm, and what type of talent or qualifications do you look for?
That's a great question. Thank you. My area of the firm is not currently hiring, but Daniel, if you want to expound on maybe places we might need some help.
Of course. So we're always looking for new talent when it comes to analysts and associates. So definitely some experience in finance is preferred, but the best resumes sometimes don't have the ability to move and react to different scenarios. As Owen mentioned, our strength is our size of the firm. So ideally, we're looking for individuals who have a finance background, but also are willing to come and learn, because you're going to be exposed to a lot of things since we're working directly with the sellers. And that's one of our strengths, is not only working with the sellers, but also providing opportunities for everyone involved to work directly with them and learn multiple facets of the industry.
And Marv asks, are you more equity or more debt investors?
Equity.
Equity.
We're equity. Yep.
And you've gone over this before, but I want to make sure that our viewers understand. Floyd Ray asks, what is the exit strategy for your 506c investors? How do they take profits and move into the next?
Daniel, I'll let you take
So
that.
the investors that invest in the fund, there is a 5 to 7 year hold. So let's say we invest in 7 different companies or so. Each time that company, we exit the company, we distribute profits to the investors. So essentially over the 7-year window, we have to exit the companies through a private offering or through an IPO. After those, during the 7-year period, we will be distributing cash flow to the investors through dividends and also large sums whenever we exit the investment throughout that 5 to 7 year period.
And something worth noting there as well is during the 5 to 7 year period when we're issuing those distributions, after the first year, those distributions are extremely tax efficient. You're taxed at capital gains, potentially, of course, depending a little bit on your individual circumstance, rather than as income, which you would get from a traditional dividend through a stock.
Yeah, and if you can explain this out a little bit more, I'm going to try to combine a few questions into one. Joanne and Sue want to know how this is structured. Specifically, you are a registered broker-dealer, is that correct? And you're taking investment directly into your company, or do you have separate vehicles set up to invest into each company? If you could hash out how it's structured, that'd be great.
Daniel,
Yes.
do you want to take this?
Correct. So we are a fund that collects the pool of money that invests in 5 to 7 different companies. So Fieldpoint Equity Infrastructure Fund is the vehicle that pulls money from different LPs to be able to invest in a portfolio of companies. A portfolio of companies is important because not only gives you exposure to different aspects of infrastructure, but also minimizes your risk, because most of the time when you're investing in a single stock, you're stuck to that single stock. Think about an index approach to investing, right? You invest in you're exposed to different companies at different rates. That's the beauty of investing in a fund, because you're investing in a portfolio company as opposed to a single investment.
And to further answer your question there, Anna, to further that, Fieldpoint Equity is, we invest in assets, right, in businesses, and to that magnitude, you're not a broker dealer per se at that point, even though as high as the regulatory is for our industry, plain and simple with private equity, very high regulatory, you don't register physically as a broker dealer per se if you're not deemed selling securities. So this being the case, we're investing in companies and assets that would not deem qualify as a security.
Thank you for that. Anthony Fitzgerald wants to know if these distributions will be on your K1 or 1099.
K1.
K1. Talk a little bit about how you're navigating this high interest rate environment we're in.
That's a great question. So right now, as everyone knows, high rates environment means borrowing is very limited, and banks are less than willing to make investments. That means that everyone in the industry is having to figure some other paths forward to closing transactions. Because we've been doing this for over 10 to 15 years, we have built the relationships that allow us to have access to private capital. I don't know if you guys have heard, but private capital is taking the spots of banks at the moment. So instead of going through a regular lender, there are other private equity funds, there are other wealthy families or other companies that are providing loans in lieu of a bank loan.
Well, gentlemen, we are out of time. I would love for one or all of you to give a quick closing for this presentation. It's been a really great time speaking with you. So whomever would like to speak, the floor is yours.
I'll go ahead and finish it up. Well, first of all, thank you everyone for the fantastic questions. They were really excellent questions. Thank you, Anna, for hosting us. And we really look forward to having more conversations with you. Go to our website, fpefunds.com, or feel free to email or call our firm, and we're happy to have a conversation with you. Thank you so much.
Great job. Thank you, gentlemen. We hope to see you again in the future with some updates. Thanks so much.
Thank you.
Bye-bye.
All right. Bye.